return of President Trump will lead to more volatility. Will the favorable outlook of firm growth and falling inflation give way to stagflation? The start of President Trump's second term has already been volatile for financial markets. The prospects of sweeping US deregulation and fresh tax cuts have spurred equities to record highs this year. But the new US government's crackdowns on immigration and sudden tariffs on Canada's, Mexico's, and China's exports threaten the favorable economic outlook. Investors should prepare for a more turbulent 2025 that will offer opportunities as well as risks. In the US, we expect a soft landing for the economy, deregulation and tax cuts to support financial markets. But tighter immigration and fresh trade wars may stoke inflation, forcing the Federal Reserve to keep interest rates above 4%. This would push Treasury yields higher and strengthen the dollar further. In Europe, the risks of high US tariffs and weak economic growth are likely to make the European Central Bank keep easing monetary policy. We expect the ECB's interest rates to fall from 2.75% now to 1.5% this year, helping weaken the euro below parity against the US dollar. And in Asia, US tariffs are likely to curb the region's exports. For example, lowering China's GDP growth from a solid 5% last year towards 4% this year. In response, Asian governments may loosen fiscal policy to support growth. We think investors should favor equities given the prospects of tax cuts and deregulation in the US and further stimulus in China. But investors should be underweight fixed income and stay cautious on duration. The risk of inflation rebounding this year is likely to lift long-term 10-year US Treasury yields back to their 2023 highs of 5% again. I'm Mansoor Mohyuddin, and this is Bank of Singapore Research.
For more information, please refer to this month's monthly investment guide.